Now let's talk about bullish debit spreads, and I'm going to let Helene take over this presentation. Helene selects debit spreads for our advisory service and newsletters, and she's been selecting debit spreads since she was a student. So I'm going to let her do this part of the presentation, and I'll come back in later on.
Hello, everybody. Today I'll be talking to you about bullish debit spreads. So the great thing about bullish debit spreads is that they can profit if the underlying stock or ETF is up, flat, or even down at option expiration. And so what this consists of is buying an in-the-money call option and then selling a related call option with a higher strike price with the same expiration date. And so this call purchase and sale can either be done simultaneously, or you can purchase a call and then sell a call at a later date to leg into the spread. So some attributes of a bullish debit spread is that the call option purchase will profit if the price of the ETF increases, and then the call option sold will profit if the price of the ETF decreases. And the great thing, once again, is that your risk is limited to the cost of the spread. So we normally initiate these spreads with 1 to 3 months until expiration, and typically they cost between $600 and $800. And you can trade these spreads in a portfolio of debit spreads in a $5,000 trading account, and once again, your risk is limited to the cost of the spread. So the full profit potential of the spread is realized if the underlying ETF closes at or above the strike price of the call option sold. So if you sell an at-the-money call or an in-the-money call, the price of the underlying ETF does not have to increase to realize the full profit potential of your spread. So most of the time, we can realize a 30 to 40% return in the ETF if it's flat at option expiration, and also still profit if the ETF is down 10%. Obviously, you have a much higher probability of success as a trader if you can profit when your ETF is flat or down. So debit spreads actually work just as well in down markets as well. During the 2001 and 2008 severe bear markets, we profited from bearish ETF spreads. So the difference between bullish and bearish debit spreads is that bearish debit spreads use put options, where bullish debit spreads use call options. So now we're going to go over some examples of recent bullish debit spreads that we did using the simultaneous entry. And keep in mind, these spreads use options that expired in 1.5 to 2.5 months out. Our first example is going to be SOXL, and that is a symbol for the leveraged semiconductor ETF. SOXL had a high RS, or relative strength. As you can see circled below, it was in the high 90s. And then the daily price chart above shows that SOXL retraced near the middle Keltner channel, setting up an entry point to initiate the spread trade. As you can see below, our brokerage confirmation shows that we bought to open 3 contracts of the SOXL February 140 calls at $3,590 and sold to open 3 SOXL 150 calls at $2,900. And this created an option debit spread that you can see below. SOXL was trading at 166.72 when this trade was initiated, and we bought the 140 call and sold the 150 call, making this an in-the-money spread. By subtracting the cost of the 150 call from the 140 call, you can see that we had a net debit of $690, which means that the cost of the spread was $690. So in-the-money spreads gives us more downside protection and a higher probability that the trade will be profitable. In-the-money spreads can profit if the underlying ETF is down as much as 10% at option expiration. The Hughes Optioneering Team actually designed a series of calculators to calculate the profit potential for option trades, including debit spreads. And these calculators calculate the profit potential for an option trade based on the price change in the underlying stock or ETF at option expiration. So we used the calculator to calculate the profit potential for this SOXL trade before we took the trade, which is something that we always do. As you can see below, the calculator will calculate the profit potential for a trade assuming various price changes in SOXL at option expiration. And so this example shows a range from a 10% increase in price to a 10% decline in price. And you can see that we filled in the stock symbol, the current stock price, the buy strike, buy price, the sell strike, and the sell price. The second row from the bottom shows you the dollar profit potential, and then the bottom row lists the percent return profit potential. So if SOXL is up at all or flat at 166.72 at option expiration, a 44.9% would be realized before commission, which is circled below. If SOXL is down 10% to 150.05 at option expiration, a 44.9% return would still be realized before commission. Just going over what we just saw, if SOXL is up, we're going to see a 44.9% return at option expiration. If SOXL is flat, we're still going to see that 44.9% return at option expiration. And if it's down 10%, we are still going to see that 44.9% return at option expiration. So profiting 44.9% when your ETF is flat or down 10% gives you a much higher probability of success as a trader, and it has allowed us to achieve a better than 3-to-1 profit to loss ratio, which is our goal. In the money spreads gives us a more downside protection and a higher probability that the trade will be profitable. So now we're going to go on to our next example, which is EDC, which is the symbol for the Leveraged Emerging Markets ETF. So EDC had a high RS and retraced the middle Keltner channel, setting up a buy opportunity. As you can see, it was in the high 90s for its relative strength. Below, you can see our brokerage confirmation that shows that we bought to open 3 contracts of the EDC February 107 calls at $2,155 and sold to open 3 EDC 115 calls at $1,565. So this created an option debit spread that you can see below. EDC was trading at 126.03 when this trade was initiated, and we bought the 107 call and sold the 115 call, making this an in-the-money spread. By subtracting the cost of the 115 call from the 107 call, you can see that we had a net debit of $590. So the total cost of the spread was $590. In-the-money spreads gives us more downside protection and a higher probability that the trade will be profitable. In-the-money spreads can profit even if the underlying ETF is down as much as 10% at option expiration, which is why we love these spreads. So as you can see below, using the calculator, if EDC is up at all or flat at 126.03 at option expiration, we're going to see a 35.6% return, which would be realized before commission. Additionally, if EDC is down 10% to 113.43 at option expiration, we're going to see an 8.9% return, which would be realized before commission. So just going over that one more time, if EDC is up, we're going to see 35.6% return option expiration. If it's flat, we're still going to see that same 35.6% return at option expiration. And if it's down 10%, we're still going to see 8.9% return at option expiration. So once again, profiting when your ETF is flat or down 10% gives you a much higher probability of success as a trader.